Hi, and welcome to this week's podcast episode. Today I talk about how the hack of the DAO happened and how it changed Ethereum forever. Enjoy the episode. This hack was enabled by the split function, a mechanism which originally was to protect the DAO. So, due to a recursive call vulnerability, it was possible to transfer your Ethereum to a child DAO. And when the original DAO wanted to burn your governance tokens, you could basically again transfer Ethereum to a child DAO before burning your token. Before I start, I have to say that some key information come from Laura Shin's book, The Cryptopians. It is linked in the show notes, and if you're interested in Ethereum and how it all became founded, you should definitely check it out. So let's dive right into the story. Imagine it's the year 2016. Barack Obama was president of the United States and the mannequin challenge went viral. In January of 2016, Bitcoin was trading around $430 and Ethereum was even trading below $1. Yeah, I should have invested at that point of time. But even Ethereum was not trading for long at below $1. Instead, in mid-March of 2016, the Ethereum price more than tenfolded. This also meant there was a good chance that the Ethereum ecosystem could prosper. Of course, this also meant there was money to be made. And even though not completely new, a new contract became more and more popular. The invention was called DAO, short for Decentralized Autonomous Organization. You might be wondering right now, what's a decentralized autonomous organization? How can an organization be autonomous and how can it be decentralized? And what should that be? So ideally, a DAO is an organization owned by the members without centralized leadership. It is an application, a smart contract where the rules, the code is visible to everybody. Traditional companies often have a conflict of interest problem, which is described in the principal agent theory. The owner of a company, the principal, hires the agent, for example a CEO, to run the company. And both of these parties have self-interest. Now imagine a real-world example. I own 51% of a publicly traded company and I appoint a CEO in order to run the company for me. The salary of the CEO is also linked to the stock price to incentivize him to perform good. And now the CEO cuts the R&D spending, the research and development spending, which in turn lead to short-term profits. These profits ultimately lead to a higher stock price and the CEO earns a higher salary. After a short stay at the company, let's say maybe 2 or 3 years, the CEO leaves the company. The company, however, fails in the future to bring new products to the market because of the R&D cost decreases and suffers in the long term. And this is only one example traditional companies have. Just think about all the headlines about illegal and unethical behavior. And what about irrational decisions like M&A deals with stupidly high costs only because a CEO wants to build an empire at whatever the cost might be? And the list of human errors goes on and it is long. And now imagine a corporation which is basically open source computer code. It would be controllable, right? And decisions must be rational, because they are manifested in the computer code, aren't they? So let's talk about how the DAO became founded. Bitcoin was a reaction to the financial crisis and tried to create an alternative monetary system. And when cryptocurrencies are an alternative to our monetary system, can DAOs be an alternative to the traditional institutions? The German brothers Christoph and Simon Jensch had this idea together with Stefan Thurl. Originally, the three wanted to found an Internet of Things company which uses the blockchain for door locks. For example, you can make an Ethereum transactions to unlock a door lock. And Christoph Jensch also worked on the Ethereum blockchain before. He was a lead tester on all the clients and he was responsible for finding weaknesses in Ethereum. So ideal conditions to start their own project on the Ethereum blockchain. Now they only needed funding, but they decided against the traditional way. Instead, the DAO was born. Their DAO, called the DAO, also known as Genesis DAO, should function as a vehicle for crowd investments. On the website of the DAO, it said the mission is to blaze a new path in business organization for the betterment of its members, existing simultaneously nowhere and everywhere and operating solely with a steadfast iron will of unstoppable code. The DAO followed the principle lex cryptographia, or called in English code as law. So how exactly did the DAO work? In exchange for Ethereum, investors had the opportunity to receive DAO tokens. These tokens functioned as governance tokens, and the investment process would have worked as following. Any DAO token holder could make an investment proposal. For example, a proposal to invest 10,000 Ethereum in a specific protocol. In the next step, there was a possibility to vote. One token was worth one vote. If the proposal is accepted, the company which receives the funding, often called service provider, has to fulfill certain objectives. So the funding is not paid as a lump sum, but rather after certain steps are fulfilled. Imagine like a checklist where if you check one box, you receive funding from the DAO. If the DAO profits from the investments, the returns can be used in further growth of the DAO or to be redistributed to the DAO token holders. Now you might have thought about some risks, and one major risk of such a structure is called a majority attack. This is an attack in which 51% of the token holders decide that the whole money should be sent to them and 49% of the investors remain with an empty contract. So the DAO implemented two safety mechanisms against such an attack. The first one are the curators. They made sure that the proposals were legitimate and they checked them first. And they were also there were also very famous curators on the board of the DAO. The second safety mechanism is a split function. So if you do not like the proposal, you had the possibility to split into a new DAO, a so-called child DAO, which has the same smart contract as the original DAO. And this function should protect minorities. And if you split from the original DAO, your tokens of the original DAO will be burned. So it's like you're then part of a new DAO and not anymore part of the original DAO. This new sophisticated concept of the DAO attracted thousands of investors, enabling the DAO ultimately to raise 150 million US dollars in Ethereum, which at that point of time was 14% of all Ethereum. So on June 17th, a hacker used a bug in the code of the DAO to drain the funds from the DAO and ultimately drained 50 million US dollars from the DAO. This hack was enabled by the split function, a mechanism which originally was to protect the DAO. So due to a recursive call vulnerability, it was possible to transfer your Ethereum to a child DAO. And when the original DAO wanted to burn your governance tokens, you could basically again transfer Ethereum to a child DAO before burning your token. So instead of just transferring your, let's say, $1,000 in Ethereum one time to a child DAO, you could do it again and again and again. So ideally, it should have burned the DAO tokens first, your governance tokens first, before transferring the Ethereum to the child DAO, but it was like a software bug. And this is the story of how one hacker was able to drain $50 million from the DAO, 1/3 of like the whole investment sum. And now the question is, was this transaction legit? Was it really a hack? Was it a hacker? Because if you think about code as law, the question is not easy to answer. And it is also not easy to answer because the DAO was, so I'm not a lawyer, but it was thought like a legal construct, something which is neither legal or illegal. And it also ultimately led that the Ethereum blockchain was forked. So this means that there are now two Ethereum blockchains, because one blockchain, the Ethereum blockchain, which has like the same name, today decided that this transaction was not legit. They don't wanted a hacker to have such a high amount of Ethereum. And you really have to think of it, because if like the DAO had around 15% of all Ethereum, the hacker would have had 5% of all Ethereum. And the other blockchain said, okay, blockchains are mutable, and they forked to Ethereum Classic. And I really want to know your opinion. We have a Discord channel, and I put the link in the show notes, and let's discuss on the Discord channel how you think about that. And personally, I think it is hard to decide, because on the one hand, it says code is law. And when code law is, then it would be, let's say, at least not illegal for the hacker to drain the DAO. Is it illegitimate? Probably yes. But it would at least not be illegal, right? On the other hand, if you think about the blockchains, there's also a community which can decide which they want to accept and what they don't want to accept. And for example, if the community decides they do not want to accept this, they could make like a fork, or they could undo the hack, which they ultimately also have done on the Ethereum blockchain. This is not so easy, right? Because if you say you have like a decentralized blockchain which is not immutable, the fork basically speaks against all these concepts. And in the next episode, I will tell you who is, with a high probability, the hacker of the DAO. Until then, I wish you a nice day. And if you want, you can recommend my podcast to your friends, because it would really help me to grow the project. Have a nice day.